Dakin Campbell, welcome to the Tailwind Podcast.
Yeah, thanks so much for having me.
So we're going to talk about your book called Going Public, which came out in 2022 and chronicles the tech industry's quest to improve the process of taking companies public. First question, why did you write this book?
Yeah, good question. At the time that I pitched it, there was a big debate in the markets about direct listings. IPO market was starting to really heat up. This is 2020, beginning of 2021. And lots of people, Bill Gurley, others, were talking about how direct listings were a preferable way for tech companies specifically to reach the public markets. And so, like a lot of things, I sort of got curious about it and really wanted to go deep to understand whether it was the preferable way or why it might be. And so I felt like that was the best way or an interesting way to do that would be through a book.
Got it. And Dakin, your background prior to the book, so you've been a business reporter at Insider for quite a while, right?
Yeah. So I've been a financial journalist for about 20 years now. The first 10 years of those, with a couple short stops before, was at Bloomberg. And then I've been at Business Insider for the last 8+ years. And really, in 2019, I wrote a feature story about WeWork. It was in the fall. Their IPO had just sort of crashed and burned. And my editors came to me and said, there's been a lot of news and reporting and scoops about WeWork, but nobody's really taken a step back and written like a definitive narrative feature about WeWork. And so I did that, and it was hugely successful. It got something like over 1 million hits. And that led a book agent to reach out to me and say, hey, would you like to write a book about WeWork? And I said, I don't really want to write about WeWork specifically. It felt overexposed to me at that point, or it wasn't quite interesting to me. But I said I would like to write about the IPO markets because it was right after Spotify and there was this whole debate about direct listings. So that was sort of the backstory behind the backstory of the book.
Awesome. And just to get some definitions out of the way before we dive into all this, what is the difference between a direct listing and a traditional IPO? And then also we should probably make a distinction between direct listings pre-2020 and direct listings after 2020.
So a direct listing is basically when a company, a private company, lists its shares on an exchange, which makes it public and allows the shares to be bought by retail investors and to be traded and bought and sold on an exchange. It's called a direct listing because you're directly listing the shares and making them available to the market. An IPO is basically a managed listing, maybe is a different way to think about it. A private company hires investment banks. The investment banks go out and in a bunch of private meetings line up investors. And then the investment banks basically manage the process of selling those shares to those private investors. The next day after the IPO, those shares are then listed on the exchange and they become available for retail investors to purchase and to buy and sell on the exchange. So an IPO really is sort of a managed listing behind closed doors, whereas a direct listing is just putting all those shares or putting some portion of the shares onto the exchange in sort of a direct process. Hopefully that's clear or more clear than it was.
Totally. And I think it used to be prior to 2020 with a direct listing, the company that was doing a direct listing couldn't actually raise any money during the process. So this was basically for companies, traditionally it had been for companies that were like coming out of bankruptcy and things like that. And then some tech companies realized, well, hey, if we want to be publicly traded, but we don't really want to go through the process of raising money through an IPO because maybe we already have all the cash we need. And so they used a direct listing. And then after it sort of became a kind of more popular process, I think they changed the rules. So now you can do a direct listing and you can raise money in the process, right?
That's right. I don't think we've seen a company, at least last we checked, we haven't seen a company that's actually raised money, new capital through a direct listing. But the SEC has allowed it and has put a process, the beginnings of a process in place to do that. From what I understand, a lot still needs to be hammered out with the SEC for a company that would want to raise capital through a direct listing.
So let's go back in time a little bit. And your book does a fantastic job of sort of setting the stage of just kind of how this topic sort of evolved into one that is a fairly contentious one between Silicon Valley and Wall Street in particular. What are some of the elements of the traditional IPO process that over time began to bother, in particular, folks in Silicon Valley?
Yeah, I think the biggest thing is the so-called pop on the first day of trading. So often with popular tech companies, you'll see them do the IPO at a price. And then when they start trading the next day, the share price will double or triple or it'll go much higher. And so folks like Bill Gurley and others have looked at that first day trading and considered that as the price that the company potentially could have sold the shares at, not the significantly lower share price that they sold shares at in the IPO. And so a lot of companies, Silicon Valley companies, have thought and worried that by going through an IPO, they are selling their shares at an artificially lower price and thus raising less money. I think that's the big thing. And what I learned in my research is the pop really didn't happen or didn't really exist until the late 90s when you had the dot-com boom. And it was actually Mark Cuban's company, which I think was like an internet radio company, popped 250% on the first day of trading, and it made the cover of the New York Times. And that was sort of the first time people were really talking about this first day pop and whether it was a healthy sign of a successful offering or not.
I think a related part of that is some people started to figure out, I mean, I think even like Steve Jobs was sort of calling this out when Apple was going public, was that there's sort of like some cronyism to some degree, where basically like the bankers who are underwriting the IPO give their clients discounted shares going into an IPO. And then those clients who are not subject to any sort of lockup, unlike employees or early investors in the company, can very quickly flip the shares basically like at the IPO or kind of on the first trading day. It seems like that also just sort of rubbed people the wrong way, which is understandable.
Yeah, I mean, it's really a matter of incentives. When an investment bank is hired to do an IPO for a company, there's only going to be one IPO, most likely in that company's history. And that company may want to do a follow-on offering or sell other debt or something, but it's going to be pretty episodic work for the investment bank. On the other side, they have these trading clients that they're dealing with every single day and hearing from every single day, and the salespeople are talking to them on the phone every single day. And those trading clients want to get shares in the IPO, and they want those shares to be as cheap as possible so that when the company starts trading, they can either sell them for a higher price, or even if they don't sell them, a higher price in the market will allow them to sort of immediately mark up their position. What Steve Jobs and others have said in my book and elsewhere is, who are you going to be more likely to listen to and want to make happy? The person or the client you're talking to every single day who's giving you lots of money through trading commissions, or the client who's only going to do one IPO with you ever and might have other episodic business for you, but you might not, after the IPO, you might not talk to them or need to hear from them for weeks or months. And so when you put it like that, and when you stack up the incentives, you can sort of understand how IPOs have gotten the criticism that they've gotten and how they've developed the way that they have.
Totally. So I would say historically, this sort of comes to a head, as you mentioned, in the 90s. And then when Google is planning to go public in 2004, they want to do things differently. They come up using this model, which is essentially akin to a Dutch auction, where basically investors submit bids for how many shares they want, and at a certain price, then the IPO price is set at the highest price at which all those shares could be sold. So instead of going to the highest bidder, the price is set at a price where even the lowest bidder could have invested. They go through this process. How, in the end, was Google's IPO process perceived by the general investment community?
Not well. They initially wanted to sell their shares at something in the, I think, 132 or 135. They ended up selling them somewhere in the 80s, I think 85, if I remember correctly. And leading up to the IPO, a lot of institutional investors had sort of turned up their noses to Google. They thought the Google guys were too smart. There were cases where the Google guys wore jeans and sneakers to meetings with these besuited Wall Street bankers and investors. And Google really, for various reasons, like turned off the institutional investor community in the lead up to their Dutch auction. And so they didn't sell it at the price that they wanted to. And it also gave lots of people a reason to pan the Dutch auction and make it sound like Google's offering failed or something. The people I talked to would argue they sold it at 85, it went to 100 on the first day, and it basically hasn't looked back. And so they would say, well, maybe that was a pretty successful offering. But at the time, it was criticized pretty heavily.
Right. And I think there was a lot of anticipation in the lead up that these guys, they were going to change the game. They were really going to improve this process, which, has sort of fallen subject to some kind of cronyism and the incentives around the pop and all this stuff. And Google was going to come in and change this. And then it was not as successful as they were hoping it would be in terms of like just the process itself. So then fast forward to 2012. So Facebook is going public. And my understanding is they didn't really want to try to innovate that much with the process because there was still this sort of stigma that was hanging in the air from an unsuccessful process that Google had, right?
Yeah, that's right. I mean, to put a fine point on it, people thought that Google was going to usher in this whole new approach, a new model for going public. And because of the perceived failure of that all quieted down. I think there were a couple companies did a Dutch auction in the years after Google, Rackspace, and a couple others, I think, but nobody big. And then, after Google, I think Facebook was the next sort of massive tech company coming public when it came in 2012.
So fast forwarding a bit more, one of the central figures in the book, really kind of, I would say, like the main driving force behind a lot of the innovations, at least that were sort of in the late 20-teens, is a guy named Barry McCarthy. He was the CFO at Netflix, I think, when it went public. And then he joined Spotify as its CFO sort of in the lead up to it going public. And by the time he's at Spotify, what is his perspective on the best way for Spotify to run its process?
Yeah. So I would say Barry McCarthy was a real student of the capital markets, and Netflix really needed a lot of capital when they were building. And so Netflix itself had to get pretty creative under Barry's stewardship as the CFO. And so by the time he came to Spotify, he felt like he had a good idea of how the capital markets worked, and he knew a lot of investors. At that time, Spotify didn't need money. They had over $1 billion of cash in the bank. But what they did need was public shares. They had employees who'd owned shares and were having a hard time selling them and wanted some liquidity. They had some investors who wanted liquidity too. And so really what he set out to do was to get liquidity for Spotify shares and get them trading publicly to make it easy for anybody who owned them to sell them. But he didn't want to raise money and further dilute investors. So with an IPO, you sort of get both at the same time. And he really tried to, I think the expression I've seen him use is split the baby, basically. Get the liquid shares without the capital raise.
One of the things that I would say he did well, or at least maybe sort of corrected some of the failures of previous attempts to innovate in this area, was that he really involved and respected bankers and Wall Street in the process. Do you think just overall in this sort of decades-long trend to improve the process of going public, do you think there's been this sort of sentiment, at least on behalf of Silicon Valley, of sort of like sticking it to Wall Street? Has that hurt their efforts to reform this process?
I would say if you were to compare what I know about the Google guys and how their team was thinking about it and how Barry McCarthy and the Spotify guys were thinking about it, yeah, there was a difference. I mean, in 2004, it was after the dot-com crash. There was lots of talk about investment bankers giving their choice clients, like investment bankers actually got investigated and got in trouble It wasn't just people grumbling about the process. There was like some actually improper activity. And so at that point, Silicon Valley's opinion of Wall Street was probably at a very low point. And so, yes, the Google guys did not respect the investment bankers at that time. I think a lot of Silicon Valley did not at that time. And I think when it came time for Spotify to go public, I think they would have been happy to not need the bankers or not use the bankers. But McCarthy had these long relationships with bankers that he'd used throughout his time at Netflix. And honestly, the SEC was not very willing to sign off on a process that didn't involve the bankers in some way. So yeah, it was different. And there is, I think it goes through cycles in terms of how Silicon Valley sees Wall Street and whether they respect the job the bankers do for them. And sometimes they don't. To put it mildly,
yeah,
I would say.
Yeah, that was putting it mildly. I mean, it's kind of like I think both Wall Street and Silicon Valley, it's almost two batteries. They kind of come together, they're friends, and then they sort of, it is, there is a cycle to it. Let's talk about Unity. So the folks at Unity, in particular, Kim Jabal, who's the CFO, she's very experienced in this area. They're exploring the best way for Unity to go public. I think this is in 2019. And she goes and she tries to study what the recent innovations had been. This was after Spotify had done the direct listing. So she's sort of gathering data points. She's talking to all the folks in the industry. And at this time, there was a lot of conversation going on about this because this was late 2010s. We're well into the ZERP era, and a lot of tech companies were going public. So there's the big discourse going on about the problem with these pops and all this stuff. So she tries to get to the bottom of it to really sort of figure out the right pros and cons for Unity. In the end, they decided to go with I'd say a fairly traditional process, but with some tweaks. And those tweaks were really aimed at trying to make sure the folks who bought shares were long-term shareholders and were not sort of hedge funds that were going to flip the shares very quickly. Ultimately, how does that process go for them?
I think the process goes well. I think the pop they get on the first day, and that's certainly one way to judge it, I think was somewhere in the 30% range. I think people would say, you talk to bankers and company executives, they'd say a 30% pop is perfect. It's like enough that the people who got your shares in the IPO are happy. It's not so much that the corporate executives are feeling like they left money on the table. And so everybody can feel pretty good about that deal. And what I think was really interesting there were a few things that were interesting about the Unity process, but I think one of them was sort of how they thought about their investor base, which you mentioned. They really started, I guess, from 18 months or 2 years out from their IPO, really courting investors and getting to know investors. I think they had a cocktail party or two in San Francisco where they had institutional investors from around the world to come in and hear about the business. And the idea there was typically, historically, I would say, companies hire investment bankers and they leave it up to the investment bankers to know the institutional investors and to manage the process. And every company is different, but historically companies would say, like, we're going to pay you your fee, and you go out, you talk to the investors, you tell them our story, you find the best ones, you bring them to us. And what Unity was trying to do was maybe cut the bankers out of that process a little bit, or really get a better understanding of their eventual investor base. And they did that. They came up with a spreadsheet. They made a spreadsheet of hundreds of rows with different investors on it, and lots of different fields, basically creating a database of the investors. And they went through and figured out what investors they wanted to be holding their shares in the months and years after the IPO. And so they took a much more hands-on approach to creating, I would say, or shaping their investor base right out of the bat. And that was interesting. And I think folks who do read the book would find some of the meetings and some of the negotiations around the Unity story pretty interesting, because I was able to recreate some of those conversations. And it really, really tells you like how these negotiations play out in a way that I didn't always understand or appreciate.
Yeah, it is incredible. I mean, when you're reading the book, you feel like you're in the boardroom. And yeah, I mean, it read as though you were in many boardrooms for 4 years. And yeah, it was pretty incredible. How many people did you interview for the book?
Think I did something like 150 interviews, if not more. At some point, you stop counting.
Wow.
I probably stopped counting at around 150.
Yeah. It's a really interesting area because it seems like people have really strong opinions about this. And it just seems like for some people, it's been years long or decades long sort of grudges about how this process goes. You touched on this earlier, but one of the main criticisms is that when a company raises through the traditional process, when there's a pop, what that represents is that they should have actually priced the shares higher. So there wouldn't be like a 50 or 100% or 150% pop. And therefore, had they priced the shares higher, they could have raised more money for the company. For some companies, one could sort of do the math and say they're costing themselves hundreds of millions or even a billion or more by underpricing their shares in an IPO. And I think part of the accusation there from folks in Silicon Valley is that bankers are sort of maybe sometimes steering companies to underprice a little bit. So their clients get advantageous pricing. And so there's a pop because when there's a pop, bankers can sort of market themselves to future companies saying, look, we took this company public and look, there was this great pop and everyone thought it made headlines and all that. That's a polarizing opinion. It seems like not everyone has that opinion that the pop is necessarily indicative of an underpricing, and an underpricing there's an argument that underpricing could be a good thing long-term in some cases. So I just said a lot there. Yeah, I would be curious to hear your thoughts on that whole topic.
Yeah, no, you're absolutely right. And I think that's what makes a good book is sort of playing in that tension and coming to understand it. The folks who think what you just laid out is wrong often rely on mechanical explanations of the market, which is fair, but they will say one reason you're getting the pop is because you're only having a small amount of the shares available for trading. And so because supply is constrained with the same amount of demand, the price has to go up. And they would also say, I would say that they would argue that the IPO is a momentum play and that the risk of overpricing the shares or basically like pushing the price as high as you can in the IPO so much that you might risk the shares trading down on the first day.
Totally.
That they would say that's a bad thing. Like you do not want your shares to trade down on the first day of trading because then that's bad momentum out of the gate as a public company and sends a bad signal to the market. And if the shares decline enough, it could become a self-fulfilling prophecy. I'm not sure I buy that. People have said, I think Barry McCarthy has said, after my shares go public, like, don't talk to me for 6 months. We have to put out a couple earnings. And if the earnings are good, it doesn't matter what the day-to-day share price is doing. And it doesn't matter if the share price declined on the first day after going public. If you've got the money and you're putting up the money, investors will reward you with a higher share price.
One of the undercurrents of this whole topic is that there are fewer public companies now than there were 20 years ago. In fact, I think you wrote that the number of public companies in the US peaked in 1996. I was surprised about that. I thought it would have been 99 or 2000, but it peaked in 96 at 8,000 companies. Then it declined to about half of that in 2010. Can Congress do anything to address that? They can lower the regulatory requirements. Aside from that, like, is there something they can really do to incentivize some of the highest quality, most exciting tech companies to have their sort of years of adolescence in the public markets instead of the private markets? Or is this just the new normal?
I mean, frankly, it feels like the new normal. We're seeing private markets becoming more like public markets with much more frequency and strength than we're seeing any innovations or any push to make companies go public sooner in their life cycle. It's a little hard to know what can be done. At this point, I don't think it's only regulations that are keeping private companies private for longer. I mean, the availability of capital to them in the private markets is just so much greater than it was 20 or 30 years ago. And I don't see those capital pools changing anytime soon. And a lot of those investors, a lot of those capital providers are quite happy with the private deals that they're negotiating. They're bilateral in many cases. They can keep them quiet. They get their own terms that they dictate. So I think for as long as you have the trillions of dollars in private capital available to companies to keep growing, I think it's very hard to think of what other things could change, regulations or otherwise, to encourage companies to come public sooner.
Yeah, agreed. It does seem like the new normal. But I will say, as we're having this conversation, there are reports that some of the largest private tech companies are thinking about going public this year, notably SpaceX, OpenAI, and Anthropic. These are capital-intensive companies, so it makes sense that they, although I think they can keep raising in their private markets, but they would likely, I think, look to raise money. In other words, I don't think they're going to do a direct listing and not raise any money if they do go public this year.
I mean, to your point, and good for you for noting it, because no sooner do I talk about all the pools of private capital that are available, but if you've got a rocket company and a couple compute-hungry AI labs, even they are finding the limits of the availability of private capital in the world.
True.
So that's what's bringing them to the public market. So if companies like them need so much capital that they do manage to exhaust the pools of private capital, then yeah, they will have to come public. We just haven't seen many that need hundreds of billions of dollars like these guys seem to.
Right. What's your expectation for how innovative they may try to be with what their go public processes are going to be?
The trade-off with innovation is risk. So if you're a management team and you feel like there are so many investors out there who want to buy into your IPO or buy your shares when they're public, then the risk of a successful offering is decreased. And so you feel more confident to try innovative things. And so certainly with SpaceX, I mean, Musk has shown himself very willing to try innovative things and to push the boundaries, not just in engineering, but in financial markets. And so we are already seeing they're going to push, according to reporting in other outlets, they're going to try to push to get SpaceX shares included in indexes sooner than usual, which would require them to be bought up by index following passive investors. I think I've seen something, and I'd ask your listeners to fact check me on this, but about the lockups, SpaceX thinking about adjusting how they structure a lockup, which is typically 6 months. When it comes to the labs, they need so much money that it feels to me that they might be in less of a position to feel like they can be innovative, that they just need so many investors to be so positive on them that they may not want to go outside the box very much. But I don't have any reporting on that to suggest one way or the other. That's just how I'm seeing it.
Yeah. So much of the book, I would say, is sort of this community-wide effort to reform and to improve the go public process. How do you think folks in the finance departments of tech companies nowadays look back on that era of trying to reform it? Are they inspired, I guess, to try to pick up the mantle and try to move forward what the folks in the book tried to do 5 or so years ago? Or is there some impression of, let's not try to get too creative here?
Yeah, the folks I've talked to, I would say in general, look back at that time as a time of unfinished business. In 2020, 21, I think they felt like they had a lot of momentum to break up the traditional IPO process as it had been done for 40 or 50 years and to really make lasting changes. And I think the IPO winter that took hold in early 22 that carried arguably through last year really chastened a lot of people and made management teams feel like any leverage that they had built up in that prior period, that they'd lost it. And so we are seeing some slight innovations coming this year, particularly around lockups. But from the people I'm talking to and the stories I'm reading, there's not that same sense of change and of even sort of camaraderie or of like a shared push to create something new.
Interesting.
Looking back at it now, the book does feel like it sort of captured this moment in time that sort of has left us and will come back eventually at some point, but in a different form.
Yeah, it very much was a moment in time. And it was on the back of 10 years of basically very low interest rates that was sort of a key part of a lot of tech companies being created and scaling very well during that time. And you're right, it is sort of there is kind of a game of leverage. And certainly those tech companies had it in that 2019 through 2021 period after, the last 3-4 years of the window being somewhat closed or has begun to open. The leverage has totally shifted back.
Yeah, it's interesting. As a student of business cycles, it's interesting to see how it's swung back and forth. But it does feel like, particularly with the disruption that we're seeing now with AI, it does feel like software companies, a lot of tech companies don't have a lot of leverage right now.
Yeah. The rest of this year, it's going to be interesting as we talked about those 3 companies that there had been reports of them going public. Very curious to see how that plays out now with what's been happening in the markets the last couple of weeks. And none of them are sort of SaaS companies, but it could be an interesting year in the stock market. It always is, but there's something particularly interesting as far as tech stocks right now going on. And so, Dakin, I know we're over time, so I will let you go. Thank you so much for this. This is a phenomenal book. I really recommend it to anyone interested in business and tech and finance. And it was great chatting with you today. Really appreciate it.
Yeah, thanks so much. Thanks for your interest, and I really enjoyed the conversation.
Same here.